Hey, Jason here. Today's video I'm going to answer is still company Ternium, stock ticker TX, a great investment. This is investment analysis for David C, who requested this on YouTube. Before I get to that though, I need to let you know you can get this series of podcasts anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos here on YouTube, make sure to subscribe, hit the notification bell so you're notified every time we release a new video. We release new videos all the time. Okay, before I actually get into the analysis, again, I apologize if you see my other videos. I don't want to do this. I have to do this because every time I don't, I get nasty comments. I don't short sell ever. So any stock I talk negatively about, I don't benefit from. I also don't own any stock in a long position in any stock I talk positively about, so I don't benefit either way. Why I'm doing this analysis is at the request of viewers who want to learn how to evaluate stocks better, faster, and more efficiently, so you can spend more time evaluating good stocks and getting rid of the crap stocks faster. Because these are viewer requested, I often don't know what the company does, and I purposely keep it that way because I don't want that to bias me in any way, positively or negatively. I don't care about what the company does at this stage. I don't care what the company CEO says they're going to do. I don't care about any of that until far later in my analysis. Why should you listen to anything I have to say? Because in the first 9 years of my career, I produced average annual investment returns of 23.5% per year on average. This puts me just behind the great Warren Buffett in the first 9 years of his career when he was at the Buffett Limited Partnership, where he produced 24.2 average annual investment returns for his investors. I'm not saying that to brag. I'm just saying that to prove to you that, that I actually know what I'm talking about a little bit. What else? I think that was it. So, again, I apologize for that. I don't want to do it. Have to do it because I get nasty comments. Okay. So, where did my screen go? There we are. Okay. So, doing Ternium, SAADR, stock ticker TX here. When you see ADR here, it means it's a foreign or non-US based company listing its shares in the United States, specifically on the New York Stock Exchange. This company has a big dividend, 3.9% rounded up. Market cap 10.7 billion. This consensus for PE here. I don't care much for PE. But when I do, I want it to be under 20. So this is one side of the company may be massively undervalued. Okay, so Ternium SA is a flat steel producer operating in Mexico, Brazil, Argentina, Colombia, southern United States, and Central America. Produces finished and semi-finished steel products and iron ore, which are sold either directly to steel manufacturers and steel processors or end users. The company operates in two segments, steel and mining. In its steel segment, the company produces slabs, billets, and round bars, hot rolled coils and sheets, bars and stirrups, wire rods, steel pipes, and other products. The mining segment sells iron ore as concentrates, fines, in parentheses, and pellets. The vast majority of its revenues come from the steel segment. Its geographical segments are Mexico, the southern region of the United States, and Brazil and other markets. It's a Luxembourg-based company, which is a bit odd, based on where it is located, but maybe there's some kind of murder, buyout, I don't know. Okay. Their revenues have jumped from 9.2 billion in 2011 to 11.9 billion in the trailing 12-month period. That growth is good. Their operating income has skyrocketed from 1.3 billion rounded up in 2011 to 3.1 billion in the trailing 12-month period. Partly because of their revenue increase, mainly because of their operating margin increase. Their operating margin has gone up from 13.9% in 2011 to 25.7% in the trailing 12-month period. I will get into why that's probably risen so much, at least in the most recent year, on that in a second. But over the long term, I look for operating margins to be above 10% on a consistent basis. For most of the last decade, they have been. Their lowest number in the last decade was 8.1% in 2015. So operating margins are good. I'm guessing that their trailing 12-month operating margin is so large, doubling from actually 2020 at 12.4% to 25.7% now. My guess is this has increased so much because of the supply shortages of many products, including steel worldwide, which has allowed companies to raise their prices on things like steel. That would be my guess as to why their operating profits has shot up in the last year. Dividends are going up. Their payout ratio in the last 12 months is only 17.3%, so their payout ratio could go up, but they could pay even a higher dividend. But again, they may not continue to produce their huge earnings and their huge operating margins and huge operating profits, because if inflation goes down or it doesn't stay as long as some people think, steel prices probably will fall, or pretty much almost certainly will fall. They have bought back 1 million shares in the last decade. That's good. Book value per share has gone up pretty dramatically from $28.74 per share in 2011 to $43.55 a share in the trailing 12-month period. Again, that's probably partly due to the increase in steel prices. Maybe they acquired something. I'm not really sure. We'll figure that out more when we get to the balance sheet. Okay. Because their margins have gone up, their cash flow has also skyrocketed from $46 million in 2011. Excuse me, I got something in my throat. To $1.3 billion rounded up in the trailing 12-month period. That's a gigantic increase. Again, partly due probably to the higher steel prices, but this huge increase has been going on to some degree since 2015. Something probably changed in the business in 2015. Because actually that's their second lowest year in revenue as well. So I'm guessing something changed in terms of their business. Maybe they acquired something. Maybe they focused on efficiencies. Maybe they focused on productivity. I'm not sure, but something probably in 2015, 2016 changed for the business to make it more efficient and making it more profitable. Okay. Their returns on invested capital are pretty good. Again, 2015, 1%, 2016, 11.5%. So again, I'm seeing signs that, and we haven't talked about this before, but when you see something like this, major jumps in 1 year, and then going forward, something happened. Again, probably 2015, 2016 timeframe, maybe 2014, that massively improved the business in terms of its operating profits, free cash flows, ROICs. Something I would want to know if I was doing further research on this company, I would want to figure out what happened. Is it sustainable? Which it looks like it is, because their ROICs, operating profits, and free cash flows have all been significantly higher since 2015. So I'm assuming that change is going to be permanent at this point, because it's been, 5-6 years. But I would still want to know what that is. Was it an acquisition? Was it a divestiture where they focusing more on efficiencies? Did they gain some kind of competitive advantage? Do they have a patent? I would want to figure out what happened in this time frame, 2014, 2015, 2016. But before that, their margins did not meet my thresholds. In ROIC, I look for anything above 10% on a consistent basis. They didn't reach 10% 1 year before 2015. Since 2015, though, they've reached a ROIC higher than 10% in 3 of the 5 years, and it's at 24.2% right now. Again, huge jump from 2020, 8.4%, 24.2% now in the trailing 12-month period. Again, I'm assuming that's at least in part due to the increase in steel prices. Okay. Free cash flow to sales. Again, from actually 2015 and on, these are fantastic. I look for anything about 5% on a consistent basis here. They were only below that once in 2017. Before that, they were below, far below. They were below 2-3%. 2011, 2012, 2013, 2014. So something, again, I'm seeing signs that something has massively improved for the company in that time frame. A decent amount of cash. 9% of their last quarter's balance sheet is in cash. Receivable inventory, we'll look at those more when we get to the cash conversion cycle and the balance sheet. Net PP&E, they should have a lot of that because they are a mining and steel company, so they should have a lot of PP&E. They actually don't have a ton of debt, which is a little bit surprising to me. They have no short-term debt according to this, and only 7% of their balance sheet is in long-term debt. Liabilities as a percentage of the balance sheet have gone down from 40.4% in 2011 to 36.5% in the latest quarter. That's good because that means stockholder equity and the underlying book value of the company goes up. So all things so far looking pretty good for the company. Cash conversion cycle has not changed much from 2011. It's fluctuated up and down, but it's risen slightly from 100.5 days in 2011 to 103.5 days in the trailing 12-month period. That means they have become slightly less efficient over time when it comes to their cash conversion cycle. That's mainly happened because they've increased their payables period. That means they pay their suppliers instead of 32 days in 2011, actually 33 days rounded up in 2011, to almost 48 days in the trailing 12-month period. That has offset a raise in an increase of 18 days in the time it takes them to sell their stuff. So they have become slightly less efficient over time, which frankly doesn't mesh with their metrics because their operating profits, free cash flow to sales, our ROICs are all up. Usually this is a sign the cash conversion cycle goes up. It's a sign that profitability margins are going down. So there's disconnect there. And what's happening here? Not really sure why, frankly, until we do some further analysis, but that is something to note. Okay, let's go with the balance sheet. We have stellar billions, so they have $540 million in, actually $1.35 billion in cash equivalents, and short-term investments. They were about a $10.5 billion company, so that's pretty good. Process. Oops, I'm on the quarterly. I'm on the annual numbers. Let's go to the quarterly. 1.38 billion in cash equivalents, and short-term investments. $13 billion worth of gross property, plant, and equipment, but that's been depreciated and impaired to the tune of about half of that number. And frankly, that's probably correct because this is a heavy machinery-based company, and you have to either maintain and or replace and or upgrade equipment all the time. So that depreciation, unlike many depreciation we talk about, is most likely real. Do have some goodwills from fourth quarter 2020, so there was an acquisition somewhere around there, maybe, or most likely. They have long-term equity investments in some stuff. Could be subsidiaries, could be stocks, probably subsidiary companies. They have a very clean balance sheet. Decent amount of debt, which is not a huge surprise, but it's not. They still have more cash than debt, which means they have a strong balance sheet, healthy balance sheet. This is interesting. Cumulative foreign exchange translation reserves / accumulated whatever breaks up there. That's negative $2.83 billion. I would want to know what that is. Is that money they've lost over time? Is that money they have lost now and it's just kind of a paper loss? And when they sell their positions, if and when they sell their position, they'd have to recognize that as a loss. I want to know what that number is. Okay. And their cash flow statement is very clean as well. I actually don't see anything of note, either positively or negatively, on their cash flow statement, which means nothing's sticking out, and which means it's relatively clean. So at this stage, Ternium looks like a potentially good stock to continue looking at for potential investment. However, let's go to valuation, where most stocks go to die for me. It is, wow, incredibly undervalued on a relative basis. I'll tell you why in a second. Let's start up top, though. Again, I don't care much for PE, price to cash flow, forward PE, but when I do, I want them to be under 20. These are at 4.56 and 5.83, rounded up respectively. Most important number down here is enterprise value to EBIT. I look for anything below 8 to consider a company undervalued. This is at 3.31, which means the company is massively undervalued on a relative basis. That is actually probably top 5, one of the lowest enterprise value to EBITs I've ever seen. So that is incredibly rare and somewhat actually very surprising, actually. Their stock chart, they have a huge range this year. They're up almost 100% this year. Why? And they're still massively undervalued. Why are they up so much? Oops. Acquitted their chairman, got acquitted from some kind of legal case. That's all that shows up in March, all the way back to March for Morningstar. Again, I'm assuming most of that is the share price rise, or not the share price rise, the price of steel rising. And that's something that we would need to figure out here. Back on the key ratios tab, that is the big concern that I'm seeing here. Yes, it looks enormously undervalued. Yes, its margins, free cash flow, ROIC are up, as is its revenue. This passes every single one of my criteria at this initial stage, which is rare. Again, I think we talked about like maybe 2, 3, 4 stocks that have been requested by viewers that have met this criteria. But this is something we haven't run into before, is the huge rise, 1-year rise in steel prices. To illustrate that, steel prices. So steel prices in the last year, have gone up from $3,791 to $5,200. Is that going to continue? If it is, how long is it going to continue? Should we count on that should we count on these huge margins, huge operating profits, huge free cash flow, huge revenue jump? Should we count on all this going forward? My guess would be no. Should we count on the short term, maybe for a year or two? Possibly. The U.S. government says that inflation won't last more than 6 to 9 months. I think it would be longer than that. But I don't know. So should we count that in the analysis? I would not. Again, this is me personally. I want as much margin of safety. So when I would go to value the stock, and again, that's still down the road, but when I would go to value the stock, I would use the 5-year average before this period, which is an average of 15.8. That is 14%. Instead of the 25.7% that it is now. I would use that number, 14%, in my evaluations based on this number. So 11.8 11,887 times 14.02%. That's $1.67 billion rounded up instead of $2.37 billion rounded up. So that's what I would do in this scenario when I value the company, which I will probably show you in an upcoming video on them, because again, this fits all of my criteria. So the next stage is to do the actual worksheet, do some minor valuations, and I will show you that in the next video on Ternium. If you have any insight into the company, let me know. I'd much appreciate it. And I'm sure David C. would appreciate it, because he's the one who requested this. Thanks for this very good analysis. Very interesting to go through. Again, potentially great looking stock here, but we're still at the beginning stage for me looking at this investment. If I missed something, if I didn't explain something well, if I should have explained something better, let me know in the comments below. If you want me to analyze a stock like this for you, I'll do so anywhere in the world. If it meets 3 criteria. If it's not a bank, I don't evaluate banks. If it's not an insurance company, because you actually have to actually dig into their annual reports to evaluate them, and it has to be producing revenue. Why does it have to be doing that? Because I evaluated some stocks for viewers that were producing no revenue, and they were frankly pretty boring and useless, because at this stage, again, I don't care about what the company does. I don't care about what they say they're going to do. I don't care what the CEO, the huge promises their CEO is making. I don't care at this stage of my analysis. So I have to have the numbers at this stage of my analysis to analyze anything. If it meets those three criteria, let me know, and I'll evaluate. I'll put on my calendar, and I'll evaluate a stock for you anywhere in the world. I am giving preference to masterclass students since we've recently relaunched that, but I don't see any requests from masterclass students on my calendar. So if you want me to evaluate a stock for you, let me know and I'll put it on my calendar. If you're watching on YouTube, thanks so much. We really appreciate it. Make sure to like, love, share, subscribe, comment, all that good stuff. And if you do subscribe, make sure to hit the notification bell so you're notified every time we release a new video, and I release new videos all the time. If you're listening on the podcast, again, appreciate it so much. Make sure to do all that same stuff, but on the podcast, we'd also really appreciate review, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more tips on how to become a better investor faster, make sure to check out our free resources below, including our 5 free gifts, which you can get the full preliminary analysis worksheet as part of those 5 free gifts at the link below. Excuse me. You can also get a free PDF copy of my book, How to Value Invest, and a free copy of our guide, 7 tips to picking great stocks and 3 times you must sell. You can get all 3 of those at the links below for free. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out the information on our newly relaunched masterclass, which I'm super excited about. We're getting students in. For that, if you want more information about that, check out the links below for that as well. But until next time, have a great day. Talk soon.